Like, love the sweaters here, gentlemen. Oh, actually, can you see the sweater? I'll have to back up a little bit, I think, right?
Yeah, what do we got here? We got Amplified Wealth. These nice little custom
Yeah, we got
for the
representation
podcast.
of the major holidays, right? We have
Yes.
Kwanzaa mat, then the menorah, and then we have the Santa hat. We got some holiday lights.
It's great. Perfect.
Hey, Nick, this is amazing. Well done.
Yeah. I'll tell you.
The question is, where are you going to wear it first, Jim?
I'm gonna wear it home for sure.
I wore mine to a holiday party. I got some questions.
Yeah, I wore mine to a few holiday parties.
Yeah. So
keep spreading the word.
Exactly.
Absolutely. You guys should trademark this Amplified Wealth.
We should.
You should.
We should. Now that we've said that, it's not.
Yeah, I was going to say, hopefully, now we're on a timeline. Now we're on a clock.
I mean,
all right, Nick, we're going to need you on that stat.
Yeah. I do have a bone to pick with you, though, Adam. Last podcast, you were talking up how genuine the Golden Bachelor was. And you almost made me feel like I needed to watch it. And then, what was it, a couple weeks later, all this news comes out about how the Golden Bachelor lied about not being in a relationship until the show, like after his wife died, and then he couldn't even kiss a girl. And then, and it turns out it's all a lie.
Oh, man. That's some juicy Bachelor drama right there.
Some juicy Bachelor drama. Yeah.
Is it gold? Can I say that? That's gold.
Oh, I guess you could say that. You could say that.
There you go.
Speaking of gold, did you guys hear about what the top traded security was for 2023?
No.
As of the beginning of December?
Bitcoin?
So not Bitcoin. So I'll give you a few hints.
In terms of dollar value or volume?
In terms of total net inflows. So the last 5 years, it was SPY, the ETF for the S&P 500.
Okay.
This year, it was an individual security. Any guesses?
I'm guessing it's gold with that lead.
No, like an individual, an individual stock. Sorry.
GLD. Is it a gold miner? Maybe?
No. It was Tesla.
Wow.
Okay.
Tesla had $45.4 billion of net inflows versus the S&P 500 ETF at $35.8 billion.
So this is the first in 5 years.
First in 5 years. Yeah, 6 years of security. That individual stock made it. I thought that was interesting.
Is the performance of Tesla good this year? I mean, I'm sure it is. It's probably one of those magnificent seven that people can't stop talking about, right?
Yep.
Oh, yeah.
They're also dealing with recalls, too, for the first time. So
I saw that.
Yeah.
Wasn't like every single vehicle recalled? Or maybe
it was something. It was but I don't think they had to take them in. I think there was like an update.
Okay.
But I don't have a Tesla, so.
But the regulators are after them now a little bit more aggressively in terms of the self-driving. It just seems like every day there's another congressman who wants to call them onto the carpet. So
it's going to be interesting because, I think the other auto dealers, they have very strong people in politics, right? But then you have Elon Musk, who has these companies that the government relies on, like Starlink and things like that. So it'll be interesting.
Yeah.
It'll be interesting.
No doubt. But the charging stations, I mean, there was an article, I think, even this morning, the demand for charging stations and the stock prices of these charging companies are way down.
Oh, interesting.
Yeah. And
I saw that. ChargePoint was one down like 90%, something like that.
For the year?
Yeah.
Maybe not this year, but 2 years ago. What was it? Or this year too? I don't know. The thing was charged. It was up at like $50 a share. It's trading at $2.45 right now. $2.45.
Okay. Wow.
So
that's
maybe
crazy,
more than 90%.
But the demand for EVs, I mean, I think they're softer than expected too. I think there's going to be a realignment in the auto industry because the growth rate seems to be slowing a little bit.
I think Tesla's just got a monopoly at this point. Like these other companies can't keep up. Ford, GM, they're trying, but they're just losing money hand over fist trying to do that.
Right.
So, it's, I don't know. I don't know what's going to happen.
And I don't feel bad for them at all. How many years did they suppress this technology? Not to get not to put my tinfoil hat on or anything like that, but I think they deserve to be where they're at.
And Austin, not to be remiss to leave out, wasn't the sentencing for, was it Nikolai, the electrified truck company? Didn't he go?
Oh,
yeah, I think he got a 4-year.
Yeah.
Nikolai. He got a 4-year sentence. For a securities fraud violation. So
the company's fine, but the CEO or the founder got in trouble. Is that?
For claims that weren't true, and investors, were relying on that information as they were investing in his company. And
were they going public at 422 or private at 420? I don't know how he never got in trouble for that.
He's Houdini.
Yeah.
For now,
I guess.
For now.
Everyone had a nice Christmas break, I hope.
Yeah.
Very
nice. Very nice.
Well, we're recording this between Christmas and New Year's, so somewhat quiet time of year. I remember this time last year was a lot of tax loss harvesting, turning lemons into lemonade, but there's still some tidying up to do across accounts.
There's always something to do this time of year.
Yeah.
But definitely quieting down a bit in terms of talking to clients.
Yes. So it's good we can record this and take some time to do that. So should we get started? Should we jump in? Jim, you ready?
I'm ready. Let's do it.
Cue the music.
Let's get on in.
Cool. So we have Jim Ferrare here. Let me just read his bio. So Jim's career has spanned over 4 decades. He began in the early 1980s as a certified public accountant, auditing broker-dealers and Wall Street-related businesses. After a few years of gathering audit experience, Jim joined a well-recognized boutique hedge fund. He then moved on to the family office world, where he gained exposure working with high net worth and ultra high net worth clients. Not too long after, he joined the registered investment advisory world, where he remains today. In addition to holding the Certified Public Accounting designation, Jim holds the Chartered Financial Analyst designation. Currently, he serves on the Advisory Council for JP Morgan Asset Management. He also served on the original Charles Schwab Advisory Board. Jim is a strong proponent of continuing education. Early in his career, he was an adjunct professor teaching accounting and taught CFA candidates. Jim has served on a numerous amount of charity boards and is a big believer in assisting less fortunate young adults attend college and prepare for a post-job graduation. That's a hell of a career there, Jim.
Well, thank you, Austin. I feel like wine. Hopefully I'm getting better with age. We'll find out.
And the firm just donated, I think it was into the 6 figures in lieu of client gifts, right? To continue on that charitable tradition. So
yes,
that's awesome. Great bio there. It's a hell of a career. I know we have a lot to get into on this podcast. We're going to talk about, your thoughts on the industry, what's changed over the last 4 decades, 40 plus years, and counting, right? But also, where are we headed, right? I think that's what I'm personally most interested in. I always lessons to be learned from the past, but I think given this time of year, we owe it to our clients to kind of recap where we've been and maybe take a stab at where we're headed. I know it's been a rocky road the last, between COVID, 2022 was tough, and, the bull market is ripping away again now. Jim, where on your bingo card was a rip-roaring 20% market year? Tell us.
That's interesting. When you go back a year ago, you had all those TD pundits saying, buy 4% treasuries. It's safe, it's secure, it's a solid return. I think that was the first real indication that 2 things were going to happen: that yields were going to go higher because they were all asking you to lock in at 4%, and perhaps the stock market was poised to surprise, as it typically does, surprise many people. The fourth quarter of 2022 saw tech coming down pretty dramatically. And, if you look at the fourth quarter of this year, it's a broadening rally, but clearly been dominated by NASDAQ, though it has broadened out beyond the S&P 500 to include small cap stocks, which have, in the last 8 or 10 weeks have also been incredible performers.
Yeah.
What a short-term jump for them. It's ridiculous.
Just,
they were just lagging along, and now all of a sudden they're up there with the S&P returns. Not quite there, but definitely respectable.
I agree, and I think in our field, gentlemen, I think you'd agree that having a hefty dose of skepticism is a good thing to have. I mean, when everyone is on let's buy 4% treasuries, you should be thinking perhaps that's either early, late, or there's a better game in town, and there was a better game for both stocks and bonds.
Right.
So,
Right. Yeah. In terms of returns, that 4% treasury was wrong across the board, right? You had stocks, S&P 500's up over 20%. The aggregate bond market is up over 6%. They're really, if you're looking for safety, treasury, sure. But if you're looking for returns, that was not the right call. Or even underweight tech and then overweight financials to start the year, right?
The whole Silicon Valley Bank mess in March, we quickly forget about that. But hey, a 25% year in the market will do that.
Totally. And then don't forget too, recession. Remember in 2022, everyone's talking about a recession in 2023. The inverted yield curve is the predictor of recessions. Well, it's predicted 9 out of the last 5. I mean,
right.
It's, I do think some of these Wall Street, rules sometimes need to be overlooked. So
the isms.
The isms just don't always come true. So, I mean, this market has surprised all.
Oh, definitely.
Yeah. Recession's an interesting one to me. I am surprised we're not in one. But hey, now everyone's saying soft landing's been achieved. So maybe 24 is the year we get it, or 25. Who knows? Maybe it's a continued bull rally for AI related stocks. It will be interesting to see what's ahead.
Yeah, I think it's interesting what you said, Jim, about the analysts. The research committee here, I know that they had a call last week, and we pulled up a study from Vanguard that plotted the high forecast and the low forecast of analyst predictions every year, along with the median forecast. In the last 12 years, there was 9 different times where the actual price return at the end of the year fell either above or below the high and low forecasted range. So the analysts weren't even close to being correct.
Correct. Yes.
We have to take that with a grain of salt.
I think the greatest certainty is to assume that the masses are wrong. And if you live by that, you'll probably make a lot more money.
Right. Expect the unexpected, or I like to say accept the unexpected, because you can't really expect what you can't expect. But if you can accept that things are going to happen along the way that you didn't expect, then I think you'll be better off in investing.
Okay. Now say 100%. That 10 times fast.
Yeah. Right.
That's a good segue. So, in diving into what has changed and evolved over your career, Jim, I know Austin and we booked you out a couple months ago. We've been excited for this podcast for a while. Both of us are brainiacs for the behavioral finance, type of mentality and the psychological issues with investing or hurdles that you have to overcome with investing. But let's start way back when your first job in the RIA space, registered investment advisory space. What made you take that jump that you talked about, or Austin talked about, from a family office into the fiduciary world?
Thanks, Adam. So in 1999, there were 3 things that to me were very observable. One, we were on the beginning stages of an incredible transformation of wealth from baby boomers to their families. And that has played out over 3 or 4 decades and will continue for the next 10 or 15 years. So inheritance, I had a strong feeling inheritance was going mainstream. Number 2, speculative investing was on the rise. I mean, the NASDAQ in the fourth quarter of 1999, I believe, was up 50%, half 100. So in the fourth quarter, wow. You can imagine these .com stocks were just going crazy. And at that point and soon after, Wall Street in general lost all credibility. And we can talk about that a little more in depth. But it became very clear that Wall Street was not concerned about the average investor, the retail investor, the high net worth investor. They were only concerned about the institutional clients, and that would come at a cost to them. So those are my three reasons. When I look forward, I said, I think I need to leave the family office space and start working with individual clients, because I believe I can help them, and I think it would be, and I think it has been, in hindsight, it has been an incredible career for me.
So it was a bit of a buy low, sell high point for, in terms of careers. It sounded like everyone didn't like their advisor. Yeah, there you go.
I bought low, but I'm still here.
There you go.
Yeah.
What was the client mentality like back then? Was it easy to rein them in from, these tech stocks booming? And what were those conversations like? I imagine it's hard to tell people to keep their wits about them in that type of environment. I mean, we haven't really seen it. We saw markets crashing in 2008. I mean, in my lifetime, I've studied it. We're students of the market, but I'm curious to hear about the client experience back then. Well,
yeah. So in 2000, 2001, 2000, maybe late 2002 was a really challenging time in the investment arena. Clients were clinging, post March 2000, the tech stocks had peaked and were rolling over. What we didn't know was that technology was about to decline 75% from its high. So a lot of investors were still married to these stocks. Those are difficult conversations to have with them. Victory was getting clients to focus on risk management and reduce exposure, to take profits, and to encourage them that it's okay to take profits. Those that did, and many of those clients are still clients today. Other clients who felt like we were out of touch and that the stocks are these .com stocks were going much higher. Perhaps they left us, and perhaps some came back, down the road. So that mentality of story stocks, where fundamentals didn't matter, it was also simultaneously, it was a period of time where the consumers would think spend today and deal with debt tomorrow. It was the antithesis of everything that we know today. To be correct, you really need to focus on managing debt, and you need to focus on tomorrow. And I think there's been an evolution in the way we manage money, where the focus has changed dramatically from days and weeks and months to years and even decades. And I'm glad to be part of pushing that change, and I think it's been to the benefit of all our clients.
A prior firm, this must have been 10 years ago, at least at this point. I remember I was working with someone, and on their desk, they kept a letterhead signed by the client, mandate from the client to benchmark. And it was dated, I believe it was dated early January of 2000, a mandated benchmark to the NASDAQ. Right. Rather than global stocks or whatever you might be benchmarked to. So yes, the fever is real. People remember that, and people have mementos like that, where the people that listen are still clients and doing great. The people that don't are, who knows where they're at.
Correct.
Yeah, I think it says something about how to approach investment. I had someone a couple of years ago ask me how we as a firm get returns for clients, and in talking to him, my words started to shape into, we're not really aiming to get returns. We're aiming to manage risk to a specific level associated with them. And it's about managing that risk. And sure, we may have some clients that want that outsized return profile. And we have some clients that want a more conservative return profile. But a lot of what happens there is just managing the risks, right? Letting the markets do what the markets do, but then having that risk overlay to then say, what, we need to stay diversified. We need to make sure that we have an awareness of the valuations of the different stocks and the different asset classes, things like that. It's not so much how do we get returns. It's managing a risk to that level of what they need.
And Austin, that's a great point, but I'll contrast that back to the 1990s, and that's when I'll call it Wall Street. And I don't view us as Wall Street. I view us as a smart alternative to Wall Street. But Wall Street analysts were many celebrities in the 1990s. I mean, when you look back and think about it, it wasn't uncommon for them to be pushing stocks, unproven business models, absurd valuations, emailing each other internally, commenting on how ridiculous this is what they were doing. But they were clearly putting their profits before their clients. And so many of these companies, when you go back, and I'll focus on 2000 tech wreck, so many of these companies actually went bankrupt. iVillage, Global Crossings, Think Tools. I mean, these are companies that people don't remember, but they were being sold. And the concept of selling to investors alone is wrong. But these were companies that were going to go in the next few weeks and months going bankrupt. So lack of regulation, a lack of ethics, no fiduciary responsibility whatsoever at the major brokerage firms in that time frame. So
right. Wasn't there a commercial about a pig wearing lipstick back then?
So there, good memory. So it was so in 2002, Charles Schwab and Company. They were not in the advice business for the most part at that time. They launched a television ad where you pictured this room, where coffee room, where 3 or 4 or 5 brokers are talking, and just saying, well, we know this company makes no earnings. We know this company has no future. We know this company most likely will run out of cash in the near term. But, and this was the phrase, let's put lipstick on the pig and sell this to our clients. So, so Charles Schwab and Company, it was their attempt, I think, jabbing at Merrill Lynch. Merrill Lynch at the time had gotten into a little bit, or soon after, got into a little bit of trouble with selling stocks that really had very little future. But back then, it's funny too, one of the networks, and if you might be too young to remember network television, back then was the way to watch TV. CBS refused to air the commercial. That's how outlandish, or that's how concerned perhaps the network was.
That's how spot on it was. You're right.
Yes, protecting Merrill Lynch for no good reason, quite honestly. But the lipstick on the pig is something that I've never forgotten. And if you even follow through and go into October, I believe it's 2000. Excuse me, I think it might be October 2002. But there's legislation that comes about called the Fair Disclosure Act that soon follows. Companies back then were allowed, to tell analysts and select shareholders basically the equivalent of inside information, and not disseminate that to all investors. No public disclosure. So there were insiders, whether it be an analyst or whether it be a very large shareholder, that had information in front of ours, and more important, timely information that we would never be privy to. This
is the company is giving inside information to select people.
Correct. Yeah. So Reg FD, and I think it was October of 2000, as I think about it, they could selectively disclose information to market professionals, certain shareholders, stock analysts, and basically create an unlevel playing field. So
that's absurd.
Yeah. I mean, it was really a legal approach to insider trading, and it took legislation following the dot-com bubble bursting to get for passage. So it's only been since October of 2000 that the playing field has been somewhat more level.
It begs the question, right? Is the market still rigged in any way? Is it more fair today? I mean, I saw, this was on Twitter, and we'll show a picture of it here. But basically on December 15th, try to follow me if you can. There was a trader. It was picked up on, these unusual trading volume websites, screens, whatever it might be. Bought 11,000 of these options out of the money, near worthless, let's say worth 20 cents a piece. About 2 hours later, it was a company called DocuSign. We all know it. We all use them very often. Hours later, news broke that the firm was exploring a sale. The stock popped 12%, and this trader turned about $30,000 into $1 million in a matter of hours.
Wow.
You can't tell me this person didn't have, maybe we're not seeing the other 70,000 trades he put on that day that didn't hit, but wow. Right?
Right.
Yep.
Yeah, that's crazy. And I wonder, does that even make the SEC's radar? Because, it's $1 million. It sounds like a lot, but is that I don't even know if that's a lot to them. Is that something that they would pick up on and investigate? I don't know.
I mean, the volume was big. Maybe it's becoming a story because it's successful, right? The narrative is always tweaked to, the stories are always tweaked to fit a narrative, if you will, that will be sensational and catch eyeballs, I guess.
Right. I mean, not to be that guy, but we don't know. That same trader could have bought the same, day of options, right, for the last 30 days, right?
Exactly.
We don't know.
Right. Maybe they lost 900,000 before they hit the million. Yeah.
Right.
It's possible. Maybe it's like those Silicon Valley Bank executives who were selling stock right before the bank went under, right?
Yeah, I remember that all over the news. The news agencies loved that. I remember seeing that, but I think what a lot of those stories left out is execs need to plan that ahead of time. So months before they actually make the sale, they need to file a legal document saying that they plan on making that sale, right? So for all we know, that had nothing to do with what happened with Silicon Valley Bank. That could have just been routine selling, right?
They maybe they knew, but they weren't selling on purpose, right? There's more than meets the eye.
I think you boys are being too nice. They were taking bonuses. I mean, you're taking bonuses, which is money away from creditors. So I think in both instances that you're referencing, those are matters that probably need a deeper dive by some regulatory body for sure. And I think, and I know with the banking crisis, they're absolutely looking to claw back bonuses because that was outright improper.
It was irresponsible what they were doing. I mean, the CFA, I mean, I don't know if this was on your CFA test way back when, Jim, but the CFA 101 would be you have to match your liabilities to your assets when you're managing money on the banking level, right? And they were just they weren't doing that at all.
No.
Yes, that CFA question has been constant for years. So yes. So I would just say, from an industry perspective, it's disheartening to see the bad actors evolve over time. They get more creative. The predatory nature of hopefully it's a decreasing number of participants. But I mean, the willingness to earn a short-lived profitable experience on the backs of less savvy investors, that's probably never going to change. I mean, you can go back to Enron, Bernie Madoff, FTX. It's greed and fear will never disappear. And our job is to help our clients take advantage of fear and to be smart during periods of greed. I want to throw out a tidbit because I know we mentioned aging and wine before. If you want a fun book that is not about stocks, but the scam analogy, read Billionaire's Vinegar. And here you get the ultra rich get taken. And it's just a fascinating read. And once again, it shows that there is no end and no boundary to greed. So I just wanted to throw that point out.
What was that? Billionaire's Vinegar.
Billionaire's Vinegar is a fun read. Yes.
Well, I not that I've read the book, but I think from what you're saying, there's this human nature of us, right? Whenever there's a system, there's always going to be someone to try to break the system or take advantage of the system. Not just investing, but whatever that system may be throughout our lives.
100%, and I think that led to the growth of the RIA industry, the registered investment advisory industry, because we, as we know on this podcast, we're different than a typical Wall Street broker in many ways. But one of the most powerful ways is that we have a legal obligation, a fiduciary duty. The client's interests always come first. That is not necessarily true when you're dealing with a typical Wall Street brokerage firm. When you're dealing with an RIA, clients always come first. And I just, when you think about the word broker, Wall Street broker, implies two things, right? Selling, and I'm proud not to sell anything, and two, a commission. So I throw back out to Wall Street. How's that model working today?
I think it was back in 2017, 18 maybe. They talked about, I think there was proposed legislation to make all advisors, broker or fiduciary, to make them all fiduciaries. And I think I remember seeing like 7 out of 10 brokers said they would probably find another type of sales job.
The industry revolted.
The industry revolted.
What do you mean I have to act in my client's best interest?
I'm not kidding. I could maybe
that's
try
true.
and find the citation and put it in the notes, but
the show notes.
The show notes. But no, that was pretty telling in and of itself, right?
Yeah. Well, it's crazy to me. You have these people who are positioned as almost like the doctor of the finance industry, right? Like, people go to them and they trust them. And to find out that a lot of them, I believe it's 85% of them, don't have to act in your best interest on a legal basis. There's only 15% of them that do. So out of every 10, only 1 to 2 of them actually have to act in your best interest all the time. It's kind of absurd to me.
And I have friends who are brokers and work for the bulge bracket firms and everything like that. I trust them. I know that they're good people. So it's not saying that every broker is a bad person, a bad actor, but they could be. Right. It's just, you don't know. When you work with a fiduciary, they have to do what's in the client's best interest.
Right. Correct. It's not an indictment on all brokers, but you'll have the confidence when you're working with an RIA to know that your interest is coming first.
Right. So the major differences here are what, Jim, between a broker and a fiduciary? Let's line this up for clients.
Well, for one, an RIA doesn't take custody of client assets. So what that really means is there's only one way we're getting compensated, and that's for the assets we manage. There's no other embedded fees. We're not making money on money markets. We're not making money on firm trading. We're not making money on any proprietary product. So the client knows that how we're getting compensated, and then we're putting interest first. And we're not selling product. And of course, we go back to, once again, that we have that fiduciary duty. So to me, those are the key differentiators between us and a typical broker.
Yeah. It's much less about picking stocks, getting them into certain trades or investments. It's much more about, we say this word a lot with our clients, holistic, right? Holistic wealth management, looking at the entire picture. So have you seen, since the late 90s, have you seen the firm's mentality shift towards more of this planning, wealth management, so to speak?
Yes, 100%. And so we are absolutely capturing younger investors. I mean, I think, you, Adam and Austin, you obviously represent one of the strengths of our firm, the youth that we have. But we also have today, the majority of our clients are 45 to 65 and older, and they're one or two camps, right? They're interested in creating a family legacy. It could involve sale of the business. It could involve charitable giving, generational investing. It could be protecting for a surviving spouse, integrating investments in estate planning. That's a big part of what we do in that segment of 45 to 65-year-old plus, big segment of where we operate. And then there's another category of clients, equally important, that are looking for that plan that we talked about, this comprehensive wealth plan that coordinates with their insurance and the cash flow and their taxes and helps them comfortably get to the finish line. So those are the two main areas that we focus in on. And years ago, people, once I mentioned earlier, they were thinking short term. They were thinking spend now, deal with debt later. It has changed. It just flipped 100%. We're now focused on getting clients to the finish line or building a family legacy with them. So, and I think two areas that interest me and keep me, that when I wake up, I'm still hungry for this industry, is because we're helping people achieve important goals in their lives.
I mean, back then too, things were more simple, right? With whether it's the tax code, whether it's the type of investments, the type of accounts. I mean, I don't know off the top of my head when Roth IRAs were created, but that's got to be a newer, in the last couple of decades thing. And it's more complicated. So you need to understand how these different levers, when you add 10 levers and you have to pull them all the right way to get a successful retirement, it becomes more complex. You need someone to walk you through this.
Well, also, keep in mind too that, 10, 20 years ago, the clients our typical client was in their late 30s now, or late 40s. Now they're in their, late 50s, late 60s. So there's less room for error. I mean, you have to get it right. You have to try to optimize their goals and work with it. And I mean, 2026, we have potentially a change to the estate tax law. We have to factor that in. 20 years ago, it didn't matter for our client, for our average client. Today, it does. So you're right. The stakes are higher, and the opportunities to create value are greater.
1997, by the way, the Roth IRA.
That's when it came out. Fun fact. Yeah, I would, from what I'm hearing, right, the industry, or at least our firm, has changed from story stock, right, to, your story.
Right.
Picking the best story stock to how do we help you complete your story, which I think is big. I think another thing that has changed is our access to information. Right now, with the internet, with AI, people have a lot more access to information, which creates a bit of information overload. It makes the client smarter, right? So they're not necessarily going to fall for the story stock all the time. And then also we can actually get into this in a bit, but that access to that information, what does it do to clients? When they approach us, the conversations we're having, and things like that, but.
Well, we're talking about how things have evolved, right? I mean, what has stayed constant over the years, Jim?
Right. Oh, yes. So, not to sound repetitive, but greed and fear will always be an important role in the markets and in our investing philosophy. And we all know it's easy to be, it's easy to fall prey to a great sales pitch. And I think if we remember back to just even COVID, March of 2020, how difficult when the Dow seemed to be, and I think actually was dropping 1,000 points a week, it was challenging. Those conversations with clients to stay true to your plan. That messaging was incredibly important, and we had to deliver it right, and had to once again reinforce the client, take that longer term perspective. So those are the moments that, and we talk about, this is, a lot of what we're talking about today is behavioral finance. Having a client stick to their plan during March of 2020, to the extent they did, what an incredible rebound they had in their portfolio, right? And I mean, I think, Adam, you and I were talking about, just look at the last 2 months in the market.
15%. What is it? Closing in on 15% in 2 months. It's right after a 10% correction, right? So the volatility is really unnerving. It's difficult to not be swayed by fear and greed, but it's ever present, which is spot on. And Jim, you had I'm going to share my screen here for a minute and play this quote I want everyone to listen to from Warren Buffett.
This will have an impact on thinking for quite a while in certain respects. But fear, greed, folly,
not going to change.
We haven't gotten rid of those. We get smarter in all kinds of ways. We don't get smarter emotionally.
Why is that?
It's just the way the human animal's put together.
The memory fades, and all of a sudden, the new temptation is there.
Yeah, and plus being greedy can be fun for a while, I guess. Leverage can be fun when it works. Yeah. Leverage is one of those things that works 99 times out of 100, and when it doesn't, it's all over.
That was great. What are your thoughts on that?
Well, first of all, I think that while I know it's Warren Buffett is aging with many of us, anyone who has a chance to go back and listen to either his top 10 quotes or read his annual letters, I think that'll be the equivalent to going to grad school. So he breaks it down to very simple lessons. But I think he's right, 100%. Human behavior doesn't change, and you constantly have to be on the lookout for opportunity because of fear, and you need to perhaps not worry about the last nickel, and it's okay sometimes to take a profit. And I notice with our clients, sometimes the higher stock goes, the more they want to buy. And I also notice sometimes in the short term, if the market or an individual investment declines in value, they're first, not all, but many are like, maybe we should sell that. But the truth is, patience is key. And our job is to instill patience into our clients in a long-term philosophy, a long-term discipline.
I mean, just think about the colors that are used when you see stock prices going up, they use green. When it's going down, it's red. Red is scary. Red is evil. Blood. Right. I mean, just as simple as that. I love how he said, greed can be fun for a little bit, and until it's not. Right. We know that. You can think back to Bill Miller in the mid 2000s. What did he do? He bought high quality bank stocks. They paid dividends. And then what happened in 2007? Zero. Right. So it's not hard to outperform the S&P 500 for 15 straight years until you lose 90% of your fund's assets. So
I mean, since we mentioned that his Bill Miller, I mean, in the mid 2000s, he also, if I remember correctly, went out and purchased a yacht and talked about managing money from a yacht. I think next time our listeners hear that, they should sell any fund where the fund manager is going to work from his yacht. You need to be kicking tires in visiting companies. And when you stop doing that, it's perhaps time to change your manager.
Yeah. I also think it's funny too. CNN Money has a literal index, the fear and greed index, which I think is funny. Austin, you and I looked into some of the actual underlying metrics, and really just if the market's going up a lot, then it leans towards greed. And if the market's going down a lot, it leads towards fear. And, hey, if you just do the opposite, buy when everyone's fearful and sell when everyone's greedy, you might do pretty good. I guess you should never really sell, though. Right?
I was going to say,
just buy more when people are fearful.
Right. Just keep buying. Because when people are greedy, people can be greedy for a while, or earnings of companies can catch up to their price. Right. But when people are being fearful, I think, and Warren Buffett has done this time and time after again, that's when it's time to really get greedy.
I'd like to just kind of, expand on Austin's comment. I mean, the rubber band evaluation can stretch dramatically. I remember in 87 in January, I think the market was up 13%. By August, it was up 42%. And by the end of the year, it was up 5%. So, picking your spot is going to be nearly impossible to exit. But I did look at, Adam, on that greed fear index in preparation for today's podcast. A year ago, I mean, that index was flashing fear. And, and once again, everyone was saying, buy 4% treasuries.
Right.
So, I mean, there is something to bearish sentiment being a good indicator to perhaps add to your investments.
Yeah, I would agree. I would agree.
Which is tough to do that, because when everyone's being fearful, you're being fearful as well, right? So you really have to look past your own thoughts, your own fears, what your own behavioral conditioning is telling you to do to take advantage of that.
And just briefly, that's why we have an investment committee. We have a group of people. We follow metrics. We follow rules, right? So when we decide what to invest in for our clients, there's a process behind it. And sure, we're all investing our own money, but when we're doing it on behalf of a client, we have a job to play. We have a role to play, and to be the ballast in the storm, the anchor to the ship.
Right.
Austin, you touched on AI. Do we want to dive a little bit deeper into AI and information?
Are they coming for us? Are they listening?
They're definitely listening. I know that.
Can we even call them they? I mean, really, is it a person? Is it a thing? We don't know.
I want to say this. I'd like to add a comment or two. Especially, you talked about major sell-offs in the market, but I think AI and technology will absolutely supplement what we do as professionals, investment professionals. But I don't see replacing our role with technology and computer thinking. I mean, part of it, when you think about, and I've done this for 4 decades, sometimes you're comforting a client that lost a spouse. You're helping them devise a new investment plan. I mean, you need compassion, not computer power. I mean, nobody wants to get an email saying you need to invest now, even though your husband passed 2 weeks ago. So, I think our clients deserve and will always deserve someone they can trust and communicate with. You need heartfelt, real life, relatable experiences in financial markets. So our role will always be there. We'll just have more tools at our disposal. But as I think Adam, you said too, but there's more complexity in the markets. There's more opportunities. There's changing tax codes. There's new investments that we can. Hopefully, we'll jump into new investment opportunities that are unproven, not time tested. So and I just use the analogy. If a coworker wrote, read an article about knee surgery, I wouldn't let him examine my knee. You want real life experience, someone that has a pulse, not a plug. So I'm highly confident our profession will only grow.
Right. I like that you worded it that way, because that's what AI is doing right now. It's reading a bunch of articles on knee surgery and then applying that to your knee surgery questions. Right. But you would never go to a friend who maybe has read every knee surgery article and say, hey, can you do this? You're going to go to a doctor. You're going to go someone who's been there, who's taken people through the surgeries, who can anticipate your needs, things like that.
Yeah. On the future of our industry, right? The future of our space, not where we are today, but where we're maybe headed. I wanted to play a little clip for you and get your thoughts, Jim. Okay. You alluded to new investment types, so I'm going to take this as an opportunity to get your thoughts on Larry Fink. Okay. This was at a recent summit with Andrew Ross Sorkin, but I'm curious to hear your thoughts, so I'll go ahead and play this.
I actually believe this technology is going to be very important. Look at it. We have been part of a huge revolution in investing through ETFs. We believe that ETFs will be changing the whole way we invest. Many people still use it as a means, people are investing it for indexing. No, the majority of people who are putting money in in ETFs are active investors that are buying exposure. The entire bond market is being transformed as we talk right now. I believe the next generation for markets, the next generation for securities will be tokenization of securities. We will, and if we can have that distributed ledger that we know every beneficial owner, every beneficial seller, we all have our code of who's buying, who's selling, instantaneous settlement. And think about it, it changes the whole ecosystem.
So that was Larry Fink. He's CEO of BlackRock, who, one of, if not the largest provider of index ETFs. Two things stood out to me in that speech there. One, passive versus active. I think this is a constant debate we're talking about with clients. So I'd love to get your thoughts on that. And then you mentioned it, you brought it up, but future investments, new types of investments, right? He talked about this term tokenization. I think instant settlement is a fantastic thing, the distributed ledger. So both of those, I would like your take on those.
Sure. So let's start with ETFs. So in some ways, he's Larry Fink is absolutely correct that there is an active decision process. First of all, which one to buy? I mean, there are so many different ETFs that cover segments of the market, segments of the world. So I agree with that. Where I'm hoping we're not going to end up is where people are actively trading ETFs. I believe the active trading of ETFs will only benefit the BlackRocks of the world and not necessarily its clientele. I do believe, and I think Warren Buffett has said as much, just to go back to him, that he would suggest that somebody strongly consider putting 90% of their money in the S&P 500 and 10% in T-bills if they didn't want to get involved with active management. So I'm concerned about the misuse of ETFs. I do believe that choosing any ETF is an active decision process. We use them for multi-year exposure. And for example, I mean, you look at today, there might be a broadening out of the market, and we may want to get a client small cap exposure. This is a hypothetical statement, but if so, it'd be so easy to do with an exchange traded fund. So I do believe it crosses both active and passive. It's a passive vehicle. It requires an active decision process. but I don't think it's meant to hold for days or weeks. I truly believe it still represents to me a multi-quarter, if not a multi-year hold.
Right. And, his comments allude to the fact that ETFs are primarily being used for trading, not for passive buy and hold investing. And it just goes to show that, again, our psyche gets in the way. Our fear and greed get in the way. We chase, the NASDAQ when it's doing well in 2021. And then 2022 happens and it drops 50%. And then we sell it and we go into something else. And then it does well in 2023. Right. So you shouldn't be in the business of trading around in these ETFs. But again, that can be where our role of advising the client on which ones to hold and for how long can really come into play.
Right. Just because you're using a passive vehicle doesn't mean you're a passive investor, right? I could see if every time you get money that can be invested, you immediately put it into your 5 passive funds, whatever they are, right? Every single time. But the minute that you say, wait, I think the market's a little overvalued, or it's falling and I want to wait for a better entry point, that's an active decision, right? And people need to acknowledge that. It's not just because you're using a passive vehicle doesn't mean you're a passive investor.
Or just to use your example, those 5 passive ETFs, what proportion of your money is going into each of those 5 ETFs? That's an active decision.
Correct.
Yeah.
Correct.
So Jim, tokenization, let's dive in.
Right. So
hopefully not too deep.
We could. I agree. So my mind. So when I hear that term, I immediately jump to Bitcoin, and we do it, though less than in a prior year or two. But Bitcoin obviously is something clients ask us about. So I'm in the camp that its lifespan is unclear. I mean, there is global acceptance that may exist for decades to come. There's no doubt in my mind that there are uses for it. It is globally accepted and highly unlikely, in my view, to be completely regulated away, or an alternative investment will surpass it, or government, digital coin will surpass it. However, let's go back to Charlie Munger recently. The financial legend recently passed. I mean, he always made a lot of common sense, and he was far from a believer. So, I'll, for sake of this, for our time allotment, I will not give an exact, precise answer to a personal belief, but I would say this: if Bitcoin ended 2024 at either 15,000 or 150,000, my position would remain unchanged. That is, it remains uncertain to the acceptance and lifespan of Bitcoin.
Austin, should I respond now, or?
Well, I would just say with any investment, and I'm calling it an investment because I don't know what the use case is for it at this point. Maybe there will become a better use case for it. But with any investment, high risk, high reward, right? So yes, if things keep planning out rosy for Bitcoin or whatever the cryptocurrency is, we would expect high returns from that. But we can't discount the high risk that we're taking by putting our money in it. And we need to be aware of that when we make the decision to buy it, and when we make the decision to buy it or not buy it, and make the decision of how much we do want to buy into it is the risk that we're taking.
Maybe we need a separate episode on Bitcoin and cryptocurrency, but
we could put a pin in it.
I think a lot of aspects of what Larry Fink is talking about have nothing to do with Bitcoin, though, right?
No, I agree. I mean, it's a blockchain. If I could jump in there, that clearly there are untapped benefits and positive changes that will develop. But I just, let's circle back a little bit. I mean, it wasn't that far ago that digital image of LeBron James dunking a basketball in an ordinary game in the middle of an 82-game NBA season was selling for $200,000. So I do see a world where instant settlement and public knowledge of who owns investments is not necessarily a bad thing. But right. I think there's going to be winners and losers in the blockchain segment, and buyer beware.
Yeah. So it can be helpful, but maybe not in terms of digital collectibles of
digital collectibles. I would say I would the king, despite correct, but then again, who knows? A Mickey Mantle baseball card can sell for millions of dollars. So Who knows?
I saw there was a recent sale like that, 7 million. I want to say.
I think
Set
you're
a
right.
record. Yeah.
Wow.
Awesome.
Wow.
Well, I know we're coming up on time here, and this has been a lot of fun, but we do have a number of sort of closing thoughts we want to get to. You've been at this a while. You're going to keep going, obviously, but for maybe not newer investors, but
Right.
any investor, what are your top, I don't want to say advice, but, maybe a reminder to them to always try and be their best and maximize returns?
Yeah. So no, thank you, Adam. So one, capitalism is not perfect, right? We know there'll be bad actors, but capitalism is also a great system, and as is investing in U.S. markets, and as is the benefit of compounding. I think for younger investors to grasp how important it is to continually invest. And when you look back over time, you'll see what I think was Einstein said was the eighth wonder of the world: the benefits of compounding. It is a powerful thing. So those are things I would instill in my adult children and my younger clients, that if you can, you should invest. You should try to save. That the U.S. markets, once again, not perfect, but it's a very good place to build wealth over time. I did want to touch upon too, some of the way Wall Street works, and I don't mean to be bashing Wall Street, but we think about the recent transactions, even in the brokerage industry. TD bought Ameritrade, and then bought Scottrade, and then Charles Schwab bought TD Ameritrade, and Morgan Stanley bought E-Trade. And you notice the word trade is in so many of these acquired companies. So there must be something that someone sees a benefit in trading, and I think what it is, it's profitable for the entity, but perhaps not so much for the individual investor. So I just want to share with investors that distinguish. You can have play money, but think about long-term investing. And if you're younger, what a wonderful opportunity it is to be a long-term investor. So, I do encourage people to take that mindset that it's okay to think down the road. It's okay to take on that financial responsibility. It's also okay to swing for the fences in your 20s and 30s, or for that matter, I mean, if at any age, if you feel that there's something that's compelling, but try to incorporate risk management into that decision process if possible.
Yeah, I know, Jim, when you first hired me, we talked a lot about Peter Lynch and our shared fandom of his. What's his key mantra? Does that play a role here in any advice you might give?
Yeah, and I know that you living in Boston, and Peter Lynch, I believe, living about 30 minutes from your home. So Peter Lynch, obviously back in the 80s, was a wildly successful portfolio manager, and he was known for investing what you know. And I think there is some valuable truth in the messaging. I think Peter Lynch was referring to, if you have a familiarity with Costco or Microsoft or Netflix, he didn't necessarily mean if you knew who LeBron James was, you should invest in him as a NFT. So, but I think there's something there. I think it is a good starting point for those that want to do it on their own. If you understand a product or a consumer product or a concept, it may be a good starting point.
Right. And I think that goes to the other point too, of it's more than just betting on a ticker symbol, right? Or trading a ticker symbol. It's investing in an actual business. And if you know that business, right, you have a better chance of being more invested in that. Now, I would argue that knowing a brand doesn't necessarily guarantee it's a good investment, but it could be a strong starting point.
Yeah. And I wouldn't even argue. I would 100% concur with you that it's only a starting point. Correct. But you might have been, depending where you're working, you might have been working at Cisco 30, 40 years ago and realized that, their routers were the future and it could have been very profitable. You may have been working at Amgen and realizing that their dialysis drugs were going to be incredibly profitable. So you do get you do pick up things from your everyday world, and to the extent you can, you should take advantage of that.
Right. And then back to the risk management topic of there's companies like Cisco who didn't make it. Right. So
correct.
Just because it's a good product doesn't necessarily mean it's going to be a good investment. And that whole managing the risk comes back into play.
100%. And I would add one more thing if we're just looking for lessons learned over 4 decades. The idea that there's someone in line willing to pay a higher price than you paid there's a name for that. And that's the greater fool theory. And that's not an investment strategy. It has to be an economic foundation. And when you apply that, you will rule out some investments that will probably save you money longer term.
Right. Don't bet on somebody being a bigger fool than you were, right, to buy in at a higher price. Right.
Correct.
Well, I can't help but notice CNBC is on the TV behind you, Jim. So, right? talk about greater fools. No, but every day you're hearing what you should or shouldn't be doing. And oftentimes those views are contradictory. One day someone's telling you to buy XYZ stock, and the next day you hear another person talking about why they don't like it. Right?
Yes.
How do you make sense out of that?
Well, I think in general, CNBC is counterproductive to the messaging we're trying to give to clients to think long term. I mean, just their programs, the 24/7 trading mentality. I don't think it helps any individual client net. Just a little bit of history. I mean, CNBC, it really took off, even though it was on the air for a few years before. It took off in the late 1990s. Its rise coincided with the NASDAQ bubble and the interest in technology names. And, today there are many shows on CNBC under one umbrella. They can offer extremely informative, engaging interviews. I mean, there's presidents, cabinet members, congressmen and women, athletes, CEOs, billionaires, and more. So, I mean, there can be great interviews. But in terms of investment value, I do think it's limited. There's limited investment value to our client. There can be some educational value. There's a lot of entertainment value. I mean,
it's getting people involved, right? I see that as a net positive, maybe.
I get the net positive, but the question is, if you're instilling the trading mentality, I don't know if you're helping client, getting them involved.
Fair. Right.
Double-edged sword. Go ahead.
Go for it.
Sorry.
I was going to say, I think it's important too that the news organizations don't need to be your fiduciary. So we can't rely on them as giving us what's in our best interest. There was an article that I had 2 clients send me about this individual economist predicting the biggest crash of our lifetime in 2024. And I won't name blast him, but he was calling for an everything bubble that's going to burst, and we were going to see an 86% crash in the S&P 500. I don't know how we got to the 86% number, but I didn't recognize him right away. And so I looked into him and realized that since the early 2010s, when he wrote this book, he's been predicting the same crash. Right. So,
I got an email this morning, actually. His name rhymes with Schmorter Schmansbury, but I don't know if that's the one. Maybe that's what you guys are talking about.
Oh, yeah. Yeah, but I think the takeaway is if you invested in 2010, right, you'd be up 360%, right? If you thought the world was going to fall apart over that long period of time, you'd be sitting in your treasuries and a couple of years ago earning nothing on them. So I think it's important for our clients and for investors in general to take the news as a grain of sand, right? You have to look behind the sensation. You have to look behind the entertainment value. Nowhere in the article did it say that this guy wrote a book in 2010 and that's been predicting the same thing and it hasn't worked out, right? They just said that he's predicting it to happen next year. They weren't giving you all the information you needed. And in fact, you look through the comments, and there's so many comments that people commented after the article was posted. They're all political. It's all about, Republican versus Democrat, versus Democrat, which I thought was funny too. It had little to do with whether or not this person's theory or thesis made sense.
I want to read this. I want to read this email because I literally got this morning. Dear reader, he's back. For years, he's been sitting on the sidelines. After selling his business, he retired to his 100-acre farm in Maryland. Okay, great. and he hasn't appeared on camera since. But now he's back with a shocking new warning, a warning with such severe consequences for all U.S. citizens, et cetera, et cetera. Right? I mean, what's the point of that, honestly?
Right. Well, Austin, I think you quoted 2010. You really, I mean, we all know, but when you go back to October 2009, only a few months before, it was one of the greatest opportunities to invest in the stock market. The run that occurred from '09 to forward has been incredible. So despite the up and down volatility that we've all experienced, the returns have been exceptional. So,
and I mean, that happens time in, time again, right? But Jim, could you think back, maybe off the top of your head, maybe you've already done some research, but top 10 moments through time that have stuck with you? Let's hear them.
So my career started in '82. So the easiest one to start with is, bond yields were exceeding 15%, and the Fed, they were trying to crush inflation. So that reference of 15% treasury yields, where for 2 years back we were dealing with half of 1% treasury yields. So clearly, 1982, I started my career when bond market yields were peaking. Soon after.
30-year
yes.
treasuries would have been a nice purchase at that point, right?
Yes. but here's the interesting thing, as would have the stock market, because the market had a PE of like 8 or 9 in 1982. And we'd have some hiccups, and we'd get to, and I'm going to get to my next point perhaps, 1987, October 19th, market loses 22% in one day. Very scary. But then I learned the importance of the Fed. So really important lesson. The Fed came in and basically said, we'll be the lender of last resort. The last time that phrase was used was the Depression in 1929, where a Fed governor said that. So the Fed reassuring everyone that they stood behind any bank and would be the lender of last resort is what stemmed the decline, I believe, on October 19th. So also, just one more point about October 19th, 87 stock market crash. There was a concept of portfolio insurance. The theory was if the market was going lower, you would just sell the S&P 500 futures. But truthfully, that was a big reason why the market dropped so much one particular day. The selling pressure that ensued because every institution was basically looking for portfolio insurance. So what we learned was portfolio insurance did not work, and actually kind of exasperated the free fall of the market that particular day. Mm-hmm. So be careful what insurance you're being sold. 1991, I remember the Gulf War. We were watching it live on television. The markets were in turmoil, but just the fact that CNN was broadcasting the war live was something that I prior was unimaginable. I'd kind of fast forward 9 years. We've talked about this. Tech bubble 2000 wasn't really a scary time. It played out over 2 years. The run-up never made sense. And, there's another expression, pigs get slaughtered, and they did. So that was an interesting time, but not a scary time. But then then if I fast forward to 9/11, 2001, I mean, there's no words to describe that day. I mean, our town in New Jersey lost a lot of wonderful people. I mean, that was just, that's a day that none of us, that I'll never forget, and my generation will never forget. So, I mean, just an incredibly sad day. Just switching to 2008, Great Recession. Now, that was very concerning. I mean, the collapse of Bear Stearns was unnerving. I mean, we were watching that unfold live. So once again, I believe the Fed made more right decisions than wrong, but that was a clearly nervous time to be an investor and to be in the stock market. Other memories, 2012, Hurricane Sandy. It shut the markets down. Never believed it was going to have a lasting impact on the markets, but if you lived in the Northeast and you experienced Hurricane Sandy, it was not to be forgotten. Fun. No, not fun at all. And once again, you can quickly get a feel for what is impactful to the markets. That was just impactful to lives and sad and costly. But you knew that even though the market shut down for a few days, that wasn't going to have any lasting effect on stock market.
That's rare. That's the rare memory, right?
That
beyond the humanitarian aspect, but the market doesn't really shut for several days at a time.
Correct. Yes, absolutely correct. And then COVID, look, the stay-at-home stocks. I mean, look at Zoom, and I love my Peloton, but look at these.
Do you still use your Peloton?
I actually still use it. You probably can't tell from this puppy sweater, but I'm lean. Go with the flow. So, but these stocks, how overdone they got, and how some analysts became cult heroes for a short period of time, and it's not important to name names. But an amazing time in stock market where people, just extrapolated way too far in the future for certain names, and many of those names, of course, are either bankrupt or just never. They're decades away from approaching their prior highs in 2000, 2001. I'm sure I left out other events that people would deem significant.
But you got 8 or 9, so we can leave some more room for future events, I guess.
No doubt we'll have a few. So, but the key takeaway, the exogenous events, they happen every 5 or 10 years, if not more frequently. Right. And as investment managers or investors listening, we'll have to deal with them when they occur. But they're part of the investment cycle. They will continue.
Right. Bad stuff will happen. If you had a crystal ball telling you all these things would happen, right? You may not invest. I actually thought it was fun. I ran some numbers, and from 82 to the end of last month, right? Throughout all of what had happened, you mentioned recessions, wars, terrorists on U.S. soil, major bubble bursting, hurricanes, a global pandemic that shut down the economy. The S&P 500 was up over 10,000% cumulative. If you put $100,000 in when you first started investing, you'd have like $10.4 million today. Wow. Just sticking through all that.
Right.
That's powerful.
Yeah. Compounding is a wonderful thing.
Yeah.
So we started off talking about last year and briefly touching on next year. And we've just learned a whole bunch of lessons. Do we want to take another stab at what could happen next year?
So, I'd like to just start with, and this is my last reference, I promise, to Warren Buffett. But he said in 1995.
He's worthy.
He's worthy of it, yes. He said at that time, the Fed chairman, Alan Greenspan, he said, if Alan Greenspan whispered in my ear what the monetary policy was going to be over the next 2 years, I wouldn't change a thing. And I think we feel the same way. You're investing in quality companies and diversifying, and you're implementing risk management techniques that are meant to survive, changes in Fed policy cycles and inflationary and recessionary times. So we believe in that theory that we're investing beyond the next 24 months. And if you're investing, I would add, you should have the time horizon and risk tolerance to do so. Otherwise, you shouldn't be investing. But that's just a side note.
That's a separate story. Yeah.
Yes.
I think you said earlier, it's not about days, weeks, months. It's about years, decades, longer, probably.
I think so.
And
correct.
Even if you're about to retire, even if you're about to buy that house, even if whatever your goal is approaching within that day, month, or week, you're hopefully going to live a much longer lifetime and need this money growing for you for very long. And I always come back to that. Time and compounding. That's the biggest things for me.
Correct. And I think for us, though, it's knowing the ultimate beneficiary, because the rules of thumb where you have to have X amount of fixed income, they don't really apply. They never really made sense. It's who are we investing for, and is that investment have a beneficiary that we're truly investing for longer term?
Right. Or cash flows. I have a 25-year-old client who has a more conservative portfolio than a 95-year-old client, right? It's just because the goals are different, even though time horizon isn't quite as long. That's what it comes down to, right? It's Austin, you said it earlier, it's going from story stocks to completing your story, your individual story as an investor.
Right. And even for that that 95-year-old, we have great wealth planning, wealth projection programs that help us say for that 95-year-old, how much money do you need to live your life and have a high probability of not running out of money? And then everything above that, right? That's really, you're investing that for your kids and your grandkids, right? You may be investing that larger portion for someone who's 30, right? So, the time, your time horizon's different. It's deeper than what you think it is.
Yeah, and I would throw out one more thing that is unusual compared to the last 12 or 15 years. My whole career was about there's opportunities in balanced investing, and balance has many definitions, but typically it means more than one asset class, traditionally stocks and bonds. But for the last 12, 13, 14 years, there were no yields that were attractive. This is the first time in close to 12, 14 years that a balanced portfolio probably has the greatest opportunity to deliver, I'd call more traditional returns over the next 3 to 5 years. You have to go back 15 years to say that. And I think investors are ingrained that they just need to be in stocks. I think there's an opportunity to consider a more balanced approach. And I think this year, clearly emphasizes that a balanced return can perform very well.
Right.
Yep. So just want to share that one point too.
Yeah. It's a good point.
Bonds might be yielding 4 or 5%, but they can perform better than that, depending on where those yields go. Yeah.
Correct. Right. And I'll throw out one more fun fact for you guys, and maybe this is something we'll all address next year. But the NASDAQ 100 today, it's having its best year since .com peak in 1999. And I guess it makes you think a little bit.
Really?
So maybe I'll end my comment there. That I think Adam, you said I peaked out at 8. Maybe number 9 is developing.
No, please not.
No. Half kidding.
So now that we're done with the intro warming up, should we get started and record this episode, Jim? No, this has been awesome. This has been a lot of fun, a lot of lessons learned. So thank you for coming on. This has been great.
Thank you, gentlemen, for the opportunity.
Thanks for coming. Yeah. Good having you.
So as we always do at the end of our episodes, something completely not investment related, kind of sharing what's new, talking about what's new. Jim, Austin, one of you want to take first shot?
Yeah. So, Jim, what's new is anything that, and I guess new listeners, anything that, that we've come across lately that we just thought would be cool to share, whether it's a book, a movie, a show on TV, a fun fact. Mine is I solved a mystery. I figured something out. I learned something new thanks to Yahoo Entertainment. I may know a person or two there, but they had a breaking story about the McAllisters. Right? Have you ever seen Home Alone? The McAllister family.
Yes.
There's this big house. There's all these kids, right? And he's going on this grand vacation. How rich were the McAllisters, right? Well, what did Mr. McAllister do? So they didn't say what Mr. McAllister did, but what they were able to do was they found the home. And they said, based on 2022 valuations, the home would be worth $2.4 million. And they did some back of the napkin math to tell them that in order to afford that home, Mr. McAllister would need to make at least $730,000 a year. So to answer all those questions out there, Mr. McAllister was probably making 70-30 plus, probably plus if he was taking them all on that expensive vacation. But I found that out, figured I'd share it. I know there's been a lot of debate on social media throughout the years, but case closed.
Well, Austin, I have to add that we had over the Christmas holidays, we had a family homemade Jeopardy, and that was one of the questions.
Oh, was it?
Yes, and it's quite ironic that you mentioned that. And I guess one or two other related questions were, what was the city they visited? I think it was Paris and New York. I'm trying to.
Yep.
So, but yes. In terms of what's new, for me, I think some recent travel. Did have a trip to South Africa that was amazing. I had never been before. Had a chance to go to Cape Town, truly amazing. And I think equally amazing was we did a safari, and I had never done a safari before. And just being so close to the animals it was an experience that I would just recommend to everyone. It was amazing. So
yeah,
in terms of newness, I guess my international travel was something special recently.
Yeah, South Africa's great. Nature is real.
Yeah.
There's certain times that you have to be very selective with when you go, right? When you plan your trip, different depending on the migrations.
That may be true. I mean, I'm not quite sure, but I would say this: what I found fascinating was the animals are not uncomfortable with you as long as you're traveling in that open vehicle. But should you be on foot or should you step out of the vehicle? It's a whole different story. They were sharing stories with us about some guests that perhaps made a mistake in stepping out of the vehicle at one point in time. But watching, yeah, exactly. But it's also, I mean, what's still unchanged is that in that habitat, I mean, they are still hunting and surviving, and you're getting to watch that live, and it's really special.
Right. You're not seeing a lion eat a wildebeest that he just killed at the zoo. Right. You're only getting that experience.
I don't think I'll be bringing my daughters to that zoo, but no, if there is such an experience.
Yes.
Jim, question for you.
Yes.
Whether on your flight or downtime, did you have a book with you or did you have an iPad with you, and were you watching TV shows, movies, catching up, or were you reading a book?
Probably, given that it was a 14-hour flight, we were doing a little bit of both. So in terms of books, I try to stay away from industry books and try to find something of enjoyment. Still favorite book would be Unbroken. In terms of movies, we do a lot of streaming. Recently watched which did not get a lot of attention, Snowfall. We were watching it on the plane. So we do enjoy streaming. In terms of other books, if I'm looking for a casual book, I mean, some of the James Patterson novels, even a John Grisham novel still interests me.
I love John Grisham novels.
Yeah.
Yep.
I mean, The Firm was perhaps just, to me, one of my favorite books he's written. So yes.
Well, the reason I ask is Austin and I were getting into this a little bit last week, but cutting the cord, what do you do in your downtime, right? And my what's new is very much not new, but I think because of the writers' strike that was going on, I'm in sort of a funk as far as new shows to be watching. Nothing really that's out or has been out is piquing my interest. But this summer, the next season of the new Game of Thrones prequel is coming out. And so I took upon the endeavor to start in my downtime rewatching. And I think there's 8 seasons, 10 episodes a pop, an hour long. I mean, that's like, 3+ straight days of watching TV. And Austin and I were talking, maybe it's our generation. I don't know, but why not just pick up a book, right?
Right.
So that's why I wanted to ask and see what your go-to is. Not that you were watching anything or reading anything in particular, but that's what's new for me. It's not very new, but I'm jumping in there on my own. My wife loves to read before bed, and I just want to zone out on something. And not.
I'll throw one more thing out that's new to me in the last year or two, and I've shared with you gentlemen before, is the gardening hobby. Just we have maybe 150 square feet that we've dedicated to growing from April to November, everything from carrots to peppers to different lettuces, onion, garlic. It's incredible. And tomatoes, my God, we have more tomatoes and we have more frozen tomato sauce than you can imagine. But it's a hobby that gets you connected to your spouse, and every morning you're tending that garden for about 4 or 5 months a year. And I think it's a pretty cool hobby that I never thought about until about 2 years ago. So I'll leave with that. If you haven't thought about it and you have the space, give it a try.
Give it a try.
All right.
Any surprises when you started this gardening journey? Was there anything you had to pivot away from or anything like that?
So I would say that one of the surprises is how idiot proof it is. Like, we did not plant, for example, cherry tomatoes, but they came up naturally because those seeds were in the ground.
Okay.
So we've learned that nature takes over. So it is pretty incredible to watch.
There you go. Expect the unexpected.
There we go. Exactly. Correct.
So, all right. Very cool.
Awesome. Well, thanks everyone for joining again. Happy New Year. Yes. I guess hopefully the recording gets out before New Year's. If not, welcome to 2024. And we will hear from everyone next month.
Yeah. Please like, share, follow, and all that fun stuff. Thank you.
Thank you,
Thanks,
gentlemen.
everyone.